Hello there. The accounting equation is one of the most important concepts in accounting and states that everything a business owns, its assets, equals everything it owes, its liabilities, plus the owner's interest in the business. Assets equals liabilities plus equity. It may look simple, but it's actually the foundation of the entire accounting system. Every journal entry, every financial statement, and every balance sheet ultimately comes back to this equation. Assets equals liabilities plus owner's equity. But what exactly are assets? Assets are simply things the business owns that have value. Cash is an asset, inventory sitting on the shelves is an asset, computers and equipment are assets, buildings are assets. Even money customers owe the business, called accounts receivable, is an asset because the business expects to collect it in the future. The easiest way to remember assets is that assets are things the business owns. Liabilities are the opposite. These are amounts the business owes to someone else. If the company owes money to vendors, that's accounts payable. If it borrowed money from a bank, that's a loan payable. If employees have earned wages that haven't been paid yet, that's wages payable. And if taxes are owed to the government, that's taxes payable. A simple way to remember liabilities is that liabilities are amounts owed to others. Owner's equity represents the owner's share of the business. Imagine selling all of the assets and paying off all the debts. Whatever's left belongs to the owners. That's equity. Equity grows when owners invest money into the business. It also grows when the business earns profits and keeps those profits in the company. The easiest definition for equity is that equity is the owner's claim on the assets. Now let's put the pieces together. Suppose a business owns $100,000 worth of assets. The question becomes, where did that money come from? Maybe $60,000 came from loans or unpaid bills. Those are liabilities. The remaining $40,000 came from the owners. That's owner's equity. So the accounting equation becomes $100,000 equals $60,000 plus $40,000. Everything the business owns is financed by either debt or owner investment. Let's see this in action. Suppose the owner invests $50,000 cash to start the business. The business now has $50,000 in cash, so the assets increase by $50,000. And at this exact same time, owner's equity increases by $50,000 because the owner contributed that money. No money was borrowed yet, so liabilities stay at zero. The accounting equation now says $50,000 equals zero plus $50,000. And the accounting equation is still balanced. Now suppose the business borrows $25,000 from the bank. Cash increases again. Assets go from $50,000 to $75,000. But something else changed too. The business now owes the bank $25,000. That creates a liability. Owner's equity stays the same because the owners didn't invest any additional money. The equation now becomes $75,000 equals $25,000 plus $50,000. Balanced again. And that's exactly what accounting wants to see. This equation is much more than a formula you memorize for an exam. It's the foundation of double entry accounting. Every journal must keep this equation in balance. Every ledger posting must keep this equation in balance. Every financial statement must keep this equation in balance. And if the equation doesn't balance, accounts immediately know something was recorded incorrectly. As you move on to debits and credits, journal entries, and financial statements, you'll discover that they all come back to this one simple relationship. Assets equals liabilities plus owner's equity. If you remember this equation, you've already learned one of the most important concepts in accounting.